although the Feds have rallied together on this nonstop speaking tour, there are still those on the Federal Reserve who think that rate cuts are late, including my first guest on the show today, who says that the Fed has a recipe for getting policy wrong.
I think Fed policy is too restrictive. I think that policy is being made on a backward-looking basis. We shouldn't be making policy based on what happened 3 years ago. That is so backward-looking, and I think a recipe for getting policy wrong. Policy should be forward-looking, not this backward-looking.
Okay, folks, again, Stephen Miran saying that now, listen, Fed probably should cut rates at least 25 basis points at a minimum at this December meeting. Let's bring him in, the man himself, Stephen Miran. It's great seeing you. Been a fan of your work for a long time. Hey, I'm going to start with just this. All of a sudden, all of your colleagues are seeing inflation everywhere. I mean, it's like, what are they saying? Help us out. Do you guys get some data we don't get? We're all of a sudden, it's like in 48 hours, 3 of them stepped up and like inflation's out of control.
Yeah, no, I mean, you're right. There's been a number of my colleagues who have been talking about that lately. From my perspective, if you look at what happened in September, the median dot, as we call it on the Summary of Economic Projections, what the Fed's projections for where policy will go in the future, it was indicating 3 cuts this year. And since then, if anything, I think all the data that we've gotten have been dovishly inclined. Inflation data came in better than we expected, indicating that the catch down of shelter inflation to where market rents are was proceeding. And the labor market data has been continued softening, as you noted. So all that should make us more dovish, not less dovish.
I would say a real moderate but well-known follower of the economy and the Fed, Claudia Assam, she put out a post yesterday saying, I keep seeing mentions of resilient demand and Fed remarks. And yet she points out that even the most recent Beige Book didn't say that, right? You saw the Beige Book, you had 3 districts that saw slight to modest growth, 5 saw no change, and 4 saw a slight softening. So again, your colleagues are seeing an economy that the Fed didn't see just a couple of weeks ago.
Yeah, I think that some of the folks who may be pointing to strong consumer demand, look, the most recent data we really have is from months ago because of the government shutdown. And yes, it's true that that data in the second quarter was revised higher and consumer spending in the second quarter was revised higher. But we still have very little data for the third quarter and no data for the fourth quarter. And so as a result, I think it's a mistake to be making policy based on such backward-looking data when the data we do have that's more recent indicates continued softening of the labor market.
So what's the data that you see that gives you conviction that at least 25 basis points, maybe even more, we should go with?
So the data that I see that give me that conviction is really thinking about inflation in terms of what does it mean, where is inflation really? And when you look at market rents, they're running at about a 1% rate. That's really low, right? Measured rents in the inflation data, because of statistical quirks of how these things are processed, of how these things are measured, are consistent with where inflation was running several years ago because they're still reflecting the inflation surge that we had in 2021, 2022, right? The way that we measure inflation takes a really long time for the data that we print to catch up to where the market actually is. Now, that catch-up is starting to happen and will continue happening. But looking at inflation and saying that it's running really high because of where there was a surge in rents and a surge in home prices 3 years ago is just so backward-looking and is an absolute recipe for the wrong policy, in my opinion.
There's so much high-frequency data out there that it feels like the Fed is loath to use or even consider. Give you an example. October freight shipments plunge. And that's just one of them. And so it feels like, again, to your point, in real time, in real life, things are a lot different than the data that, that has to be revised from 2 or 3 years ago.
I think so. I think when you look at what's going on with the way that shelter inflation is calculated, and shelter is the biggest cost for most people, their rent, their mortgage, that's the biggest cost of living for most people. The way that we're looking at it in the data is, I think, completely wrong in terms of getting a sense of where the market is today. And there's other things, too, that are completely wrong, like the way we measure financial services and portfolio management fees. Those would indicate that a stock market moving higher is automatically inflationary because people pay more management fees to their investment advisors, right? That's actually a quantity increase, but the way that it's recorded in the data make it look like a price increase, and it's not. It's phantom inflation. It's not real. And making policy based on that is a complete mistake in my opinion.
One thing I've said for a couple of years is that they really, in my opinion, need to take the Fed, blow it up, and put it back together again, because the creature from Jekyll Island was designed for and primarily for bankers and their rich clients, right? And so to make it for Main Street, give you an example. Wages. We always hear about wages, and we don't want wages to go up too much. And you think about how crazy that is. So if we think about this, if our wages go up too much, the Fed is going to crush it. So how can the average American ever catch up if the Fed's main goal is to keep their wages down?
Yeah, so we have a mandate to pursue, stable prices, which is what Congress told us, and that prevents us from that instructs us to prevent.
Can you look at this in a different way, though? Is there any way to let Main Street make money occasionally? It's like it feels like we're doomed in this. And when I say we, like just the average person watching this show, if they make too much of a raise, then that's a red flag at the Fed.
So the Fed should not be hiking rates automatically if wages increase. If wages increase because it's indicative of a supply-demand imbalance in the economy, that we've let demand far outstrip supply for one reason or another, then the Fed should hike to offset that. But if wages are going up because there's a productivity improvement, because new technologies make people more productive, or and similar things, then we should not be hiking rates automatically to offset that. Now, when you look at what's happening with wages now, right, they're not increasing the way they were in recent years. If anything, the pressure on wages continues to be downward in terms of pushing wage growth down. And you look at surveys of people saying it's harder to find a job than it was.
Right.
You look at surveys of
Right.
job availability. There's fewer job openings when you look at some of these alternative data measures like the Indeed measure. And that is all indicative of continued labor market softening. The Fed is allowing the labor market to continue softening. There's no real reason to allow it to do so, and it's a mistake for us to do so.
My greatest fear right now is that by the time the Fed gets it together and gets all of the data that they use, for the most part, and while ignoring the Indeed kind of data, the high frequency stuff that we can get real time, that they're going to be so far behind. And this is something that I think is a Powell trait. They saw, the transitory inflation, they reacted too late, and I thought they were tepid. They went too tepid, I think it was 25.50 and then 4.75s. Maybe if they'd gone 50 or 75 out the gate, they could have slowed this thing down. My point is I'm really afraid that this myopic focus on inflation, instead of, to your point, looking at what's happening on jobs, because this is part of their dual mandate, is going to put the Fed behind.
Look, I think you're hitting on something that's really important. Monetary policy works with lags. It takes 12 to 18 months probably for what we do to filter into the economy. So you've got to be forward-looking. You've got to make policy based on where you expect the economy to be 12 to 18 months from now, not where it is today. And if you're too data dependent, if you're waiting for inflation to come down, the inflation data you're looking at are a function of months ago to a year ago to more than a year ago.
Right.
You're so backward looking, and you are guaranteed to be late by not acting in advance of the change instead of waiting for the change to materialize. And what a lot of people say is they point to things like the stock market. And they say, how could policy possibly be tight if the stock market is so high? Well, I've got news for you. The stock market can be high for any number of reasons that have nothing to do with monetary policy, like AI, or like regulations being cut, or tax policy, or anything.
Or passive investing. So every week people get paid and automatically billions go into the biggest stocks, and the biggest stocks, 10 names are 40% of the market. You got another 490 names that may be reflective of the economy that aren't doing anything. So again, if we're going to look at the market, let's not look at the averages. Let's look at these individual names, and maybe you could even see in there. If you look at consumer staple stocks, if you look at just more recently, some of the consumer discretionary stuff, some of these names, they've been hammered. They are screaming that the economy needs help.
But here's the issue. If you wait for the downturn in the stock market to materialize,
Sure.
you will be too late.
Sure.
If you say something like stocks are high, therefore policy is not too tight, you are saying that you need to wait for stocks to fall before cutting rates. I think that's a huge mistake. Should we have waited for the global financial crisis to occur before we cut rates? We did. But we shouldn't have.
Right.
We should have been cutting far in advance of that had we had perfect foresight and the knowledge to do it. You need to cut before the downside events occur.
Let me ask you about the accommodative Fed policy, cutting, and ultimately the impact on mortgages. I'm going to put a chart up for the audience that shows over a longer period of time, they seem to go hand in hand, but yet we have a lot of folks on Wall Street saying there's nothing the Fed can do to affect mortgages. By the way, I also think by stop selling mortgage-backed securities, that may help mortgage rates out also.
Yeah, well, I've got a couple things to say about that. First of all, if the Fed cuts rates, I think it's absolutely going to bring mortgage rates down. I think we've already started to see that. I think we'll see more of that. But the thing to understand is that our ability to affect the economy works through balancing demand, right? We're able to control demand by making mortgages more or less affordable. Right, and there's so many things that go on in the housing market that are beyond demand, that are related to the supply of housing too. All
right, I got to ask you something here, out of left field. I'm not sure if anyone's asking you, but we've had this huge move in gold. Right, there's a big push by some like Judy Shelton and others. Hey, let's get gold back in the mix somehow. Right, a sound dollar. China's been buying like crazy. Other central banks have been buying like crazy. Gold as a percentage of the Federal Reserve's balance sheet has just come down dramatically. Is there a way, should that play a role? Should new things like cryptocurrencies play a role? And in this new economy, how's the Fed thinking about these things?
So, I think I would say I look at these things as indicative of financial conditions. Sometimes I look at them as indicative of cryptocurrencies, as indicative of new technologies that might affect the financial landscape. And so I'm interested in watching them. But at the end of the day, the Congress assigned us stable prices and maximum employment, and we do that by affecting interest rates. And so something like buying gold just isn't consistent with that mandate unless the Congress were to instruct us to do so. There are other parts of the government, like Treasury or other agencies, that may be involved in something like that.
Classic economists say we need immigration. Like, in other words, every time someone comes across the border, whether they're illegal or not, an angel gets its wing and another job is created somewhere.
Yeah.
I wish they would tell that to the folks who've just announced all these layoffs, because it sounds counterintuitive, especially when a lot of unskilled folks come here. Can we start to rethink that? Because, less immigration means maybe less demand for rents, apartments. That goes down. That's deflationary. And some are saying that helps the neutral rate go down.
I've said both of those things, yeah. But if you add more people into a relatively fixed supply of housing, you will drive rents higher. That will drive inflation higher. I believe a significant amount of the inflation that we experienced in recent years is because we threw millions of new people into the country without a sufficient expansion of the housing stock and a sufficient expansion of other forms of fixed capital. Right? The truth is that they need to live somewhere. And if they're living somewhere, then that's a place that other people in America are not living. And so that's a problem. And that was inflationary. And I think that the change in border policy, cutting down net migration to zero, potentially even negative because of the deportations that have been occurring, I think is very disinflationary, because it's the exact opposite of what occurred over the last few years.
Stephen, thank you very much.